Most people are going to spend 2026 chasing ghosts. They're going to chase the gains they missed in 2024 and 2025 by dumping their life savings into overhyped AI stocks at exactly the wrong time. But while the middle class is busy gambling, the wealthy are positioning themselves for a very different reality. And if you want to actually build wealth in 2026 and not just play the market, you need to understand why the rules of the game just changed. Today, we're breaking down the 2026 investing strategy that nobody else is talking about, honestly. Look, I went from bankruptcy in 2007 to building multiple seven-figure businesses. And I can tell you from experience, the patterns repeat, but the players change. And we are entering a year where the easy money has already been made. Goldman Sachs and JP Morgan are projecting S&P 500 returns in the 8 to 15% range, which sounds great until you realize that growth is being propped up by a dangerously small handful of companies. And here's what's wild. I've got a friend, and we'll call him Alan, who's built a massive net worth over 4 decades. And you know what he told me last month? JD, 2026 is going to separate the gamblers from the investors. In this video, we're moving past the boring financial advisor talk. We're going to look at the massive AI bubble risk and why inflation is sticking around like a bad habit and the specific middle-class traps that are designed to keep you broke while the market hits all-time highs. By the end of this, you'll have a roadmap to protect your capital and actually grow it without falling for the story stock high. Let's start with the elephant in the room, market concentration. And right now, the S&P 500 is more top-heavy than we've seen since the dot-com era. We're talking about a few mega-cap AI names carrying the entire weight of the economy. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. And these 7 companies represent nearly 30% of the entire S&P 500. That's not diversification. That's hope packaged as a portfolio. And the risk for 2026 is what I call the AI reality check. For the last 2 years, companies have been spending billions. I'm talking massive Capex on AI infrastructure, data centers, chips, software platforms. But in 2026, investors are going to stop asking, what is AI? And start asking, where are the profits? If that Capex doesn't translate into bottom line earnings growth, we're looking at a valuation correction that will hit the Magnificent 7 the hardest. And here's the math that scares me. If those 7 stocks drop 20%, the entire S&P could fall 6% even if the other 493 companies stay flat. And if you're over-indexed in just these names, you aren't investing. You're betting on a single sector to defy gravity forever. And I had a conversation with my friend Will. He's a digital marketing veteran who's been in the game for decades. He said something that stuck with me. Every technology bubble looks obvious in hindsight, but in the moment, everyone convinces themselves this time is different. And don't let 2026 be your expensive history lesson. And comment below, what percentage of your portfolio is currently in tech? Be honest. Let's see how concentrated we really are. The second major risk for 2026 is the Federal Reserve's snail pace approach to rate cuts. Everyone has been waiting for aggressive rate cuts to save the day, but the data tells a different story. Inflation is still hovering around 3%, about a full percentage point above the Fed's 2% target. And that matters more than most people realize. What does this mean for you? It means borrowing costs are staying high. It means the middle class dream of cheap debt is gone for the foreseeable future. While the headlines talk about a soft landing, the reality is slower hiring, weakening consumer sentiment, and companies that can't refinance their debt at 3% anymore. They're looking at 6 or 7%. Here's where the middle class mindset kills your wealth. People see headlines about rate cuts coming and they think, great time to buy growth stocks on margin. Wrong. That's exactly what the institutional investors want you to do. Provide them with exit liquidity. The strategy here isn't to time the Fed. That's a loser's game that even PhD economists can't win consistently. The strategy is to ensure your portfolio isn't reliant on cheap money to survive. And we're looking for companies with strong free cash flow, low debt levels, and pricing power that can pass inflation on to customers. Think consumer staples, Procter & Gamble, Coca-Cola, Johnson & Johnson. Think utilities that people can't live without. These aren't the stocks that make you rich overnight. They're the stocks that keep you rich during the chaos. This is where most people lose their shirts. The middle class mindset is built on FOMO, the fear of missing out. And in 2026, that fear is going to cost people their financial futures. Trap number 1, chasing recent winners. By the time you hear about a hot AI stock on the news, the institutional money has already moved on. If you're buying in 2026 because of what a stock did in 2024, you're not investing. You're providing the exit liquidity for the wealthy. Warren Buffett says it best: be fearful when others are greedy, and greedy when others are fearful. And in 2026, everyone's greedy for AI. Be careful. Trap number 2, falling for story stocks. And I see this all the time. Someone watches a YouTube video about the next Tesla or the Amazon of crypto, and they dump their entire IRA into a stock that has no earnings, no revenue, and no path to profitability. They're buying the dream, not the business. Dreams don't pay dividends, earnings do. Trap number 3, ignoring the foundation. Here's the brutal truth that nobody wants to hear. I see people putting their last $5,000 into a speculative crypto coin or a leveraged ETF while they're sitting on $15,000 in credit card debt at 24% interest. That's not investing. That's a math error wrapped in delusion. And to build real wealth in 2026, you have to do the unsexy things first. Pay off the high interest debt. Build that 6-month emergency fund. Max out the employer match on your 401k before you even think about individual stocks. Why? Because when the market gets volatile, and it will, the person with a cash cushion is the one who buys the dip. The person with debt is the one who panics and sells it at the bottom. I learned this the hard way during my bankruptcy. When you don't have a foundation, the first storm wipes you out. When you do, storms become opportunities. So how do we actually position ourselves for success in 2026? Here's the blueprint. Level 1, build your foundation. Before you buy a single stock, you need $10,000 minimum in a high yield savings account, earning 4 to 5% right now, by the way. And you need to be free of high interest debt. This isn't optional, this is survival. Level 2, diversified index funds. Once your foundation is solid, 60 to 70% of your portfolio should be in broad market index funds, S&P 500, total stock market, or international indexes. I know it's not exciting, but it's how you capture that 8 to 15% projected market return without the risk of a single company's AI failure wiping you out. This is the wealth building engine that runs while you sleep. Level 3, strategic rebalancing. If your tech stocks have grown to 80% of your portfolio because of the 2023 to 2025 run, 2026 is the year to take some profits. Move 20 to 30% into defensive sectors, healthcare, utilities, consumer staples, real estate. And these are the boring companies that people still pay when the economy slows down. Diversification isn't about maximizing gains. It's about surviving the inevitable downturns. Level number 4, the speculative layer, 5 to 10% maximum. Only after you've done everything above should you consider individual stocks, sector bets, or alternatives. And even then, limit it to money you can afford to lose completely. This is your learning money or your lottery ticket allocation. If it goes to zero, it doesn't change your retirement date. The key principle, stop catching up. If you miss the 2023-2025 bull run, don't try to make it all back in 6 months using leverage or options. The market doesn't care about your timeline. The market doesn't care that you started late. 2026 is about consistency, discipline, and protecting your downside while capturing reasonable upside. The 2026 market isn't going to be a straight line up. It's going to be a year of the great divide between those who chase the hype and those who followed a disciplined, boring wealth building strategy. Don't let the middle class mindset dictate your financial future. You don't need a story stock to get rich. You need a system that works while you sleep, protects you during chaos, and compounds consistently over decades. And here's the irony. The wealthy don't get rich by finding the next big thing. They get rich by not losing money on stupid bets. They get rich by being boring, consistent, and patient while everyone else gambles. And if you found this breakdown helpful, do 3 things for me. First, smash that like button so the algorithm shows this to more people who need to hear this warning before they blow up their portfolios. And the second, hit subscribe and turn on notifications. We're going to be tracking these 2026 market shifts in real time, and I want to make sure you're on the right side of the wealth gap when the dust settles. And last, check out this next video. Stay disciplined, stay invested, and remember, wealth is built in the boring middle, not the exciting headlines. See you in the next one.